Nasdaq just posted its second best one-day performance in history. But be careful, this might be a trap, specifically a bull trap, because anytime you see performance like this during a bear market, there's a good chance it's what's called a bull trap, meaning it sucks bulls into the market before another big leg down. Wednesday's single day performance in the Nasdaq was 12.02% after a 25% drop from top to bottom over just the last couple of weeks. But this is not the first time the market has done something like this. In fact, if we look at the fifth best one-day performance in the Nasdaq in history, it was October 28th of 2008. You can see the Nasdaq was up 10.9% just in that single day. Zooming out from there, you can see that the market continued to rally a little bit longer before it puked one more time and finally bottomed, and then bottomed at the same place again in March of 2009 before the ultimate rally eventually really started. Next up, let's look at the fourth best single day performance in Nasdaq history. And that day is going to be December 5th of 2000. You can see on this day, the single day performance was 11.68%. Another fantastic day. But zooming out, you can see while the market did rise for the next couple of days, it ultimately continued in its bear market a lot farther down. And because this was part of the dot-com bubble bursting, it ultimately fell for a couple of years before it bottomed and began its new bull market. Now let's go to the third best single day performance in Nasdaq history. Here we are back to 2008. We are also back to October of 2008, specifically looking at October 13th, and you can see the market was up 12.58%. And because we have already looked at 2008, you know that zooming out shows that the market had not yet bottomed, went down from there before bottoming and starting a new bull market. Now let's look at the number one best single day performance in Nasdaq history. And we are looking at January 3rd of 2001. And you can see in that one single day, the Nasdaq was up a monstrous 18.77%. But we have already looked at this dot-com bubble bursting, and we know already that that was not the bottom either. And it continued to fall after a brief relief rally as well. Looking again at Wednesday's performance, 12% in a single day. We can see that performance numbers like this are not exactly in good company. In fact, for the Nasdaq, most of the time, this just means that it is a bull trap. In other words, we've got another leg down. But it's not just the Nasdaq. We can see similar patterns with the S&P 500 as well. On Wednesday, the S&P 500 was up 9.51%. You can see from this chart here, that is the third best single day performance in the S&P 500 for the last 50 years. I want you to pay close attention to the other dates on this table. October 13th of 2008, October 28th of 2008. Those were the number one and number two best performing days in the S&P 500 in the last 50 years. Those are the same dates as the Nasdaq, which we already saw. The market eventually moved lower from there, even though there was a relief rally for a few days following those performance numbers. We also have dates like March of 2020, October of 1987, March of 2009, April of 2020, and we see on this list a general pattern that we are looking at COVID, Great Financial Crisis, the dot-com bubble bursting, and Black Monday. In other words, these massive up days in the market tend to happen when we are in crazy bear markets. And most of the time, the market is not done selling off at that time. The market and investors overall are looking for any reason possible to buy, hoping that the damage is done. And so when you have the president of the United States who is throwing tariffs like spaghetti against the wall, saying that we are going to pause for 90 days, investors take that as a sign to pile back in. Given the speed at which a lot of money bought back into the markets here, this doesn't look to be mostly retail investors. Retail investors have been buying all the way down. If you didn't see my video about this yesterday, go watch that now. It's largely been institutions and hedge funds that have been getting squeezed out. But here's the other very important takeaway. Just because we probably have another leg down doesn't mean it's a bad time to buy. In fact, looking at this table, you can see on the right-hand side, the 1 year, 3-year, and 5-year performance of the market following these massive up days. And you can see that not a single one of these numbers is red or negative. In other words, historically, following the days that the market had these crazy ups, even though the market went down after that, there was not a single example of the market still being down 1 year later, 3 years later, or 5 years later. You made money every single time. And if you notice, the worst performance on here is 10% up after 1 year following October of 2008. But some of these 1 year performance numbers are massive, like 56% in 2020 or 103% in 3 years following 2009. Now, if you feel confused and you don't know whether this is a signal to buy or sell and you feel like I'm giving you mixed signals, let me break it down very simply for you here. Number one, if you are just trading these markets, then these up and down days give you fantastic points to enter and exit, to load up on some calls and sell some puts, and then the next day to load up on some puts and sell some calls. Number two, if you are a long-term investor, at least a couple of years on your investing time horizon, it is times like this when markets have big sell-offs that are the best times in history to buy, especially if you're buying fantastic assets and you know how to make sure they're actually a good deal. If you don't, I've got a bear market investing guide. It's linked in the description below. There's a coupon code there you can use as well. This deal will only be available until the bear market is done, because then it's too late. But as a long-term investor, you need to be taking advantage of down markets like this. You can make money in bull markets, but people make fortunes during bear markets if they know what to buy and when to buy. And finally, the biggest mistake of all here is to act like a trader when you are really a long-term investor. In other words, you are looking at these up days and thinking it's time to go all in, and then the market pukes and you get scared and go alt cash. And then you look at days like yesterday where the market is up 10, 11, 12% in a single day and think the bleeding is done and go all in again. And then the following couple of days, everything dumps again. You get scared it's going even lower and you sell out, which means that you're acting kind of like a trader with your long-term investments, buying high and selling low, bleeding both ways. This is the worst of both worlds because you are losing every time you buy and every time you sell. You neither have a long-term outlook nor a short-term trader's outlook. Now, if you want a quick little tactic for being able to participate in both being a long-term investor and accumulating assets at great prices for the long term, but also you want to take advantage of what's going on right now and trade around it, the strategy is called core and explore. You have your core positions that all you ever do is add to them. If you get a big lump sum or you get consistent income, you dollar cost average into that, that's your core. You never sell, you only build. Maybe that's around 80% of your total portfolio. And then with the other 20%, that's your explore portion. That's where you add to your positions if you think they're a good deal, and you subtract from your positions if you think they're too high. This allows you the freedom to be a short-term trader with some of your money and a long-term investor with the rest. If you're wrong about the timing, it doesn't really hurt you too much because you still have the core positioning that takes care of you for the long term. But if you're right, you can significantly add to those positions over time. So to summarize, if you are looking at a 10% up day in the market thinking that that is a sign the bear market is over and it's only going to go up from here, you're probably going to be wrong. And so going all in here just to get scared out later is going to be a bad move. 1 year, 3 years, 5 years down the road from now, it is almost certain, given history, that the markets will be higher from here. But you have to hold on and you can't get flushed out. And if you are a short-term trader, days like this are usually good opportunities to flip your positions and get ready for another move down. As always, thank you so much for watching. Have a great day.